Okay, welcome everyone to our Owl Bundle user group meeting. Let me share my slide. Yeah, first we'll go through the just swing system scans to look at whether there's anything interesting. Then, yeah, Dan, I think it will be good for you to go through your slides on the system targets. And I have also some information there as a stake in the ground. And then there was interest last week in terms of other exit types. For example, using ATR-based exit. So we can go through that as well as the PSAR, using the PSAR as an exit. Then it was a suggestion for us to go through chapter 4 of Howard Bandy's book. So I'll provide a Cornell Notes summary on it, and we can discuss it further. And then if there's interest in how some of the back testing was done, we can discuss it towards the end. Okay, so again, this is for education purposes only. So in terms of the system scans, actually this past week, there was on the Dow industrials, there were a number of signals that were triggered for channeling, for overreaction, washout 5DD, as well as 551W. So it's quite active this past week. So if we go to EdgeRater, and then we're using the under my templates, there's the custom swing system version 2.5. Then we would go to the symbol, and I have the Dow industrials. And normally what I do is I go to edit and ask for 30 years of data, just so that some of the indicators require a greater length of time, more than 10 years. So yeah, so after updating it for 30 years, then we could hit run. And so if we look at what's happening from a market standpoint, it looks like things are starting to curve down. The RL 90, 30, and 10, they're all rolling down. And from a sector standpoint, it looks like XLE is still rising, the energy sector, as well as XME, the metal sectors. Actually, gold and silver and yeah, those types of commodities still rising. Yeah, it looks like XLB, XLF, SPY, and technology XLK, they're all declining. So energy and metals seem to be still heading higher. Any questions or comments?
Real quick question on the 30 years. Some of the symbols don't have 30 years of data.
Oh, no, yeah,
especially if you go
SPY.
to the if you go to oh, okay, that's just for the SPY.
Yeah.
Okay.
Actually, what I noticed, if I don't do that, then for this RL 90, 30, and 10, it doesn't display the signals, because this one is it looks over 10 years of data, requires more than 10 years of backtest data.
Okay, but the if you have a new stock or something in CBOE or whatever, and it's only got a few years of data, it's still going to work okay as long as SPY has its 30 years to calculate the.
Yeah. Yes. Yeah.
Well, and that's only for these particular
it's only for this one,
displays. Yeah. Okay.
Do we have any indication, I'd be curious to know how many times the SPY has hit 3 sigma and what the average pullback was, 3 to 4 weeks or a month later.
Yeah, yeah, we could yeah, I had sent you a slide on that subject, but we could show it here.
Yeah,
If we so this is the red is the RL90. Let me see if I
right.
could add add a slide here. Let me see. Oh, let me find the indicator here. Oh, we hit the space bar, and then you could type in SPY here. So the lower slide is the RL90, the reddish,
Yep.
and so here yeah, so like here it was back in 2020, August of 2020. It was up to 4 standard deviation above. But what I observed is, you see how this slope is rising,
Yeah.
EY is rising, and then the peaks of the red of the RL90 peaks are declining. So there's a like a bearish divergence, because this is increasing and these are falling, decreasing. So it's a bearish, and then that sort of precedes this this decline.
Yeah, but it's still shot straight up. I mean,
Oh, which one? Oh, you mean here?
yeah, I
Oh
mean,
yeah, yeah. It's just for this period. It the lower peaks. It's sort of this bearish divergence that
but
happens.
so it looked like we went from say 350 to 300 right there.
Oh, here.
No, go back left to the peak right there.
Oh,
Yeah.
right here. Yeah.
Yeah.
Maybe if you could widen the price area there, and yeah, maybe widen the vertical. Like if you drag on 400, it'll I don't know if you, oh, you can't do that with this. Never mind. Yeah. Okay. Oh yeah, that's better. That's better. Yeah, so now we go back to the 4 standard deviations in September. You can see it goes down from 340 to 310 or so.
So that's a pretty good pullback.
340 to 310 is 10% fallback. A little less than 10%. Yeah.
That'll work for me. Okay, thanks, Phil.
Okay, sure. Yeah. Okay, so let's just maybe look at the 5DDs. So okay, Nike. I'm trying to look at what triggered in the swing systems, and then look across to see if there's anything that also reinforces. So this is the 5-day down. Let me expand. So this was 5 lower closes, and here it looks like the Z-score is starting to flatten. So Nike could be a case where it could potentially begun to reverse. So there was 5 days down. Let me see the other. Well, this one is a little bit Boeing BA, and that it's also the Helfer trend is going from yellow to green, and also the season is yellow. It's in the so it's a potential so it's 5 days down, and it could potentially so you see the MACD starting to rise. Yeah, McDonald also was a 5 days down.
Yeah.
Looks like it was 30-day low. This one, oh, Johnson Johnson. Yeah, so Johnson Johnson, I think it looks more, pretty interesting. It looks like it's rolling up here, and the Z-score slope is starting to a little bit slow down.
Well, I don't know. It doesn't look like it's neither J&J or Nike look like their Z-score was flattening.
Yeah, still, yeah, something to watch.
I mean, yeah, it looks like it's just continuing on the same course for those two, the Z-score. I mean, maybe there's barely a hint of flattening,
Yeah,
barely.
yeah, it's not.
I'm not
This
convinced.
one.
Which one are we looking at?
This is CBX. Oh,
Are they?
yeah, the
Are,
energy is doing well. So yeah, it looks like the energies are doing well.
oh, maybe you take a look at the 551Ws, see if there's some different names there. Cisco, Goldman Sachs.
Yeah, the XLF was trending down on the Merck. Oh, see, Merck is
Oh yeah, look, it's the MACD.
yeah, they're all yeah, positive here. And its health trend is strong.
It's an orderly pullback to yeah, I like Merck. And it's got a good auto framer or some auto framer, yeah. Walmart.
American Express. Oh, IBM. Oh, still declining here. Yeah, so maybe yeah, Merck is a potential here.
Yeah.
Oh yeah, because 551, yeah, okay, so that's
No, can we see the Z-score on Merck somewhere?
here.
Yeah, it's the Z-score on Merck. That's Disney.
Oh, sorry.
The Z-score on Merck is improving too.
Yeah, it's improving. Yeah, so Merck might be. Yeah, this one's pretty good because it's trending higher, but now it's yeah, so this might be a case where it could continue trending higher.
Yeah.
Okay. I'll write down Merck.
Quarterly pullback within weekly uptrend and improving MACD and Z-score.
Okay, all right, thanks. So next topic is on system targets. Oh, Dan, do you want to go through your slides first?
Sure. When you get around to it, you might change that to objectives, system objectives. Or actually, it's really back testing objectives. But yeah, yeah. So okay, so yeah, you can drive.
Okay.
Yes, go to the next one. So Dr. Van Tharp made this statement once, I remember. Traders should spend 50% of their time thinking about objectives. And so I mapped that to Ken's plan, prepare, execute, assess paradigm, and just thought about where objectives come in. And obviously it's crucial for planning because you don't want to plan a system that won't fit you and it won't make the return that you're targeting. Well, you have to sort of know what your objectives are, maybe even as in fact, Van even said to stop trading, until you got yourself under control. No, I never did that, but that's what he said. And back testing is part of system development. So you obviously want to be back testing a system that you'll be able to use. And then, on the question of your objectives, maybe how much confidence you require could be in itself kind of an objective related to risk management. There's also objective implications for the rest of the trading paradigm per Ken Long, the preparation, execution, and assessment. Those are ongoing duties, kind of in a never-ending cycle, and they sort of need to fit your life cycle objective. If your life cycle objective is to lay on the beach 9 months out of the year, then you can't be a day trader. So why back test those systems? But even if you've got a system that fits your lifestyle objectives, you obviously still have to have self-mastery to be able to go through that cycle. And then finally, in the assessment, you want to have metrics that you use to assess the trading systems, make sure they're meeting your objectives. So while objectives may not, strictly speaking, require 50% of one's time, they could drive 100% of one's activities in the end. Next slide. So there's just some natures of objectives, financial return. I calculated my return objective. When I first started thinking about objectives and seeing what people put there, I always started to just kind of put 30% return, 15% risk of max drawdown or something like that. But what I really needed to do was to look at my whole portfolio and say, do I want to increase it by 10% a year? Do I want to increase it by 5% a year? And then I had to look at each of my buckets, aggressive and conservative buckets, and say, what return do I need from them? So typically we're back testing either like conservative ETF investment systems, or we're back testing aggressive trading strategies. For an aggressive strategy, you might well really want a 30% return or something like that. And so that kind of tells you, you know, what compound annual growth percentage you need. And that might kind of give you some direction on what to back test. Now, it also might give you direction on how large your position size needs to be. You know, if you have a portfolio return objective and your active trading account is only 10% of that, it's not going to have that much ability to move the needle. Maximum risk, max drawdown tolerance. Van distinguish between total equity, you know, kind of your paper gains, and your core equity, how much you put in, below which you would actually be losing money that you had before you started. So that's going to determine how large your position size can get, and what's your exit strategy, and how to manage portfolio heat. That is, how many positions do you have open, and what's the total risk for all of them. Let's go to the next slide. The lifestyle and psychological objectives, you know, what's your time budget? You know, do you want to spend, you know, one day a week on, you know, operations, but you're willing to spend, you know, 6 months upfront, you know, to develop your system. Once you have the thing running, are you willing to be on the grid most of the time so that you can manage your exits for the open positions, and you can take your setups and entries as they come day after day? You know, how much availability do you have, and what's your comfort? You know, could you handle a 6, 12 or a 12 straight losing streak or something like that? Could you handle you know, certain volatility in your trading results? So the final slide kind of brings this all together, right? For back testing. So I think, you know, what your monetary objectives, you know, what return you're looking to get is going to drive, you know, the compound aggregate growth rate that you're looking for, and the win rate that you're looking for. And your risk objectives are going to drive your portfolio rules and your exit strategies, and even how much back testing is enough. You know, you might feel that I kind of got a rough idea, you know, from the back testing. I just need to forward trade it. Or you might want to do a lot more back testing if you want to have, you know, 95% confidence and Monte Carlo distribution analysis and that kind of thing. You know, how much time you budgeted. Some of these back test results may end up showing that they were predicated on making hundreds of trades a year. You know, can you handle that frequency? The type of signal that it's looking for, the setup that it's looking for, is that something that you can automate so you just get an alert, or does it mean that you've got to look at you know, long watch lists of many stocks? I think the EdgeRater templates and things like that really help, you know, by saving you time, giving you access to a wider range of systems. And then, there's other psychological characteristics that drive what parameters you need for your systems, and therefore what is worth your effort to backtest.
Okay. Oh, great. Any questions to Dan? Well, that's great. Thank you. Thanks for thinking through this.
You're welcome. You're welcome.
Okay, so let me just continue on. So I did take a stake in the ground based on also last week's and so this is just to give a pictorial view as to what we're conceptualizing in our backtest. So right now, this is again a stake in the ground. We can adjust it, but it assumes we have $100,000 available to trade, and that we have 10 systems. We have a swing systems, a breakout system. That's the sniper radar. The Godzillas and all those different critical states. And then, so we spread 100K across 10 different systems so that we have diversification, strategy diversification. So one is mean reversion, breakout, trend following, momentum, a bear market, event driven. So like if there's earnings announcements or whatever, volatility, seasonality, and then like overseas market, perhaps the market overseas, some of them are not in phase with the US market. So some market that may be rising if the US market is falling, the other ones might be rising. So this is an attempt to get diversification outside United States, and then the rotational, like a regime switching type of strategy. Using, for example, SPY in gold, when depending on which one is stronger, may drive which portfolio to use. So these are different strategies that what we'd like to do ideally is have them be uncorrelated to some extent. But if it becomes a big bear market, then this bear market strategies hopefully should mitigate, because the others may all work in the same direction, or maybe the volatility and the bear markets would provide some buffer.
Bandy has this concept of dynamic position sizing.
Oh, yeah.
And what I think he would say is you'd want to be, if you had all these systems proven that you think they work, regardless of market type, and you're going to be using them. Well, it's not regardless of market type, but anyway, for whatever reason, he just talks about doing that based on your R multiple distribution and some other factors. He would probably say that you would add more than 10K to the ones that were doing well, but you'd keep all of them running.
Right.
And the ones that were doing poorly, you'd reduce their position sizing. But you'd have to keep them running, or you'd have to keep them running in order to even know when it was time to rely on them more heavily.
Mm-hmm.
When they were starting to improve. And then the other thing you have to throw into the mix is market type. I mean, there are certain times of year that you probably don't want to be running the bear market strategy, and certain times of year that you probably don't want to be running a long trend following strategy.
Mm-hmm.
So that might even override dynamic position sizing.
Mm-hmm. Okay, yeah, that's good. Yeah, good point. So now, right now, we've been focusing on the swing systems, which is a mean reversion system. And so now, the way this 10K is divided, it assumes that we're doing $2,500 per trade. and 4 maximum open position at any given time, with a compound annual growth rate of more than 15%. These are just targets. It's yeah, normally the CAGR and the max drawdown, you want them to be a little bit more better than 1 to 1. So this is like 1.25 to 1, with a win rate of more than 65%, and profit factor of 1.5, and expectancy of $60 per trade. So this is just a stake in the ground for what we would consider a good enough system. And then I think it's like you're saying, Dan, a lot of it is also psychology. How many trades do you want to do each year, and so forth, and average holding period. And so this is just a stake, and we can iterate on the numbers, but this is something that you see some systems offering these types of performances.
Well, the other thing that I don't know who among us could actually operate 10 systems at once.
Yeah.
I found myself able to do about 3 or 4 at a time.
Okay, yeah. So maximum.
I mean, with better automation and so forth, you might be able to improve it to, say, 5. I don't know.
Yeah. Yeah.
Or with a group, it would be great if you had a group of people all running these systems, and they were following the rules, and you had some evidence that they were following the rules, and then that could help you with the knowing which of the systems that weren't in season are now coming into season, and you change which ones you're trading based on someone else's reports.
Oh yeah, I think that's maybe a good suggestion. Well, because
divide and conquer.
Yeah, because we have I think 9 folks in our group that have EdgeRater, and so there's, if we have 10 systems roughly, yeah, we could divide them. One person could take each one.
Well, I mean, people might be trading. They might want to be making money, so they probably would want to trade the 2 or 3 that they thought would make the money. But they could agree to trade, at least one other or 1 or 2 others to make sure that the group gets the data on their performance.
Yeah, so it's more of a study group. So they could figure out. Okay, so now so with this, it's getting into how do we apply what we're learning to actual trade execution. So it depends. It's like, so one approach could be like we get a signal generation, and so it's more like the 5DD could be find the movers, and then just using the kata challenge trading techniques to trade that the mover. So for example, so the 5DD for example does show an edge, and so if you follow that edge and then you just use that as a trigger to do as a symbol that's going to move, so you can apply the kata challenge rules to it. The other way is to use an approach where the back testing results can help, adds additional information for you to make some decisions. So this is it's not all quantitative. It includes some discretion. So that's some of the things that we've been doing is in addition to for example, the 5DD signal, we're looking at risk Z, slope stat, MACD seasons, and so forth. And for example, today you say, well, Merck looks like out of the list of 5DDs, Merck looks as a potential opportunity, and then do the kata challenge trading on the Merck. Then there could be cases where we try to do more pure quantitative. So so the back testing, we include all the entry, exit, profit targets, and so forth. And here we come up with a signal, but then we would trade it manually. Yeah, in other words, we submit manual orders, but so it's more of a manual entry, but it's pure quantitative. We use the we believe the back testing is best. Don't add any discretion and just follow the back testing set of rules, the system strategy rules. And then there's some that just says let's just even fully automate. So it's more of a automatic order entry and exit. So I think right now we're more in the first two, and then we're starting to do some of this third. We're trying to come up with a more quantitative system.
Well, if you don't do the quantitative, by quantitative you mean rules-based.
Rules-based, yes.
And if you the rules-based manual and rules-based automatic, strictly speaking, if you don't do rules-based automatic, then your results are probably not valid. Nobody else could rely on your results because they couldn't repeat your idiosyncrasies, your elements of discretion in your manual orders.
Yeah, it's used. We're using the back testing more as an additional input for decision making.
Yeah,
It's more that because I was actually in a service where the person was more quantitative, using pure rules.
yeah,
But then when it came to actually doing a trade, he just used the back testing to provide additional information. But then he at the end relied on some other factors, more discretionary factors. So
yeah.
that's this sort of thing here.
Well, one could have the best of both worlds by kind of running the back testing systems all the time and sending out a report on, what the pure robots would be doing if they were running.
Mhm.
And then individuals could just trade, add a layer of discretion on top of that.
Yeah, that's true. Yeah. So that's maybe more in this camp here. It's like you can
Yeah,
decide whether or not you want to submit this order here.
yeah.
Okay, so that's um uh yeah, so that's sort of what sort of the general direction that we're heading is. After we finish the swing systems, then we would look at Ken's critical states template. Any questions or
No, I'm good.
okay.
Thanks.
All right.
Yeah.
All right. So we could go to talk about the additional exit types. So last week we talked about the fixed percent gain, 15% target. So once we exit when we make a 15% gain. In this section, we'll look at other stops, and this is to look at an ATR type target stop. And then also, what if we use the regression line crossing the PSAR as an exit? So this is just more of for conceptualize what we're doing. So the blue are signals for protective stops. This is what we have coded. And so this is like where there's a 2 ATR gap down, like there's a big gap down, and so that you generate an exit. So the blue is where we generate an exit because the previous bar had fallen by 2 ATR. So that's like a protective stop. The red signals, these are target stops. So like here, for example, the next bar here jumped up, so we would exit. We would exit because of a 2 ATR higher. And likewise here, there was a big gap up, so we would exit. So it's so this is conceptually like where Ken talks about like a 1, 2, 3 exit when something suddenly jumps up, just to protect that gain and exit. So any questions here? So that's the 2 ATR either as a protective stop or as a profit target.
Check.
Okay. So then this one here just is the same I believe slide, but just overlays the Bollinger Bands, because some use Bollinger Bands as you could use it as also a target and exit if it hits the upper band or lower band. But I think like the case here where it's all these bars all hitting the upper band, but I think you want to stay in the trade even though it's hitting the upper. This is a 2 standard deviation Bollinger Band.
Yeah.
The other thing is you notice the PSAR. The PSAR is actually if you use RL10 PSAR, it's you would stay in the trade a little bit longer. So we're also looking at PSAR exits. How does that compare with ATR exits? So the back testing was to look at we looked at SPY and the Russell's 3000 symbols. So this is a table for SPY. So the first section here is what we did last week. This is only looking at the channeling signal, the swing system channeling. So this is channeling, and then this is channeling with a 15% profit stop. And then the next grouping is the channeling with a 2 ATR protective stop and a 1 ATR target. Next one is channeling with a 2 ATR protective stop and 2 ATR target. And the next one is channeling with a 2 ATR protective stop and a 3 ATR target. So this is just looking at the sensitivity. And this next grouping is instead of using the 8 ATR, is to use the PSAR exit. So PSAR exit, assuming a 10 period, 20 period, 30 period, and then 30 period, but then changing the acceleration limit. So this is just tweaking the different parameters to see if there's other combinations.
So the 30 period seems to be very good.
Yeah. Yeah. So I just actually what I did, I just fed this data, just this data here to ChatGPT to have it analyze the data. And so then this is like the same. Oops. This slide that I just described, that's this upper right-hand corner. But then, okay, so then it says I asked it to rank order out of all these, what just to rank order based on just the data. It looked like the channeling with the PSAR exit with a 30 period and the standard acceleration, 0.02 and 0.14. Acceleration factor, acceleration limit. That seemed to that gave the highest win rate, and then a profit factor, and a good net profit percentage, and so forth. And then the next one was the 2 ATR protective stop with 1 ATR target stop. That gave second highest winning rate, and so forth. So that's the what it the one that was the lowest ranked was without the target exit. And then see the 15%, the thing that we did last week. This is the channeling with the 15% profit stop. So that was below the using the ATR exits.
That's amazing win rates on these.
Because this is SPY, and then SPY has been trending higher.
Yeah.
So we could look at now the Russell 3000
Mhm.
as a different. So this is sort of like the opposite end, where these are fairly volatile symbols,
Yeah.
and so it's the same thing. Looking at the channeling with 15%, and looking at the ATR stops and the PSAR exits. So what? Let's see what ChatGPT had to do. So it ranked. It again ranked the 2 ATR protective stop and 1 ATR target. It has the highest net profit and compound annual growth, and had a relatively low max drawdown. And then the second one was the one with 2 ATR and 4 ATR target. Here's the 15% profit stop. So the PSAR exits didn't do as well for these more volatile symbols here. And then the pure channeling was here without the target stops. Yeah, so so it looks like using an ATR target exit is also something to consider. So either profit stop is sort of a clean. It's more easy, but then we can also use ATR stops.
Yeah, those would be tough to automate. You'd have to be changing your stop every day.
Mm-hmm. Oh, the ATR.
Yeah, I don't know how I'd trade that.
Mm-hmm. Yeah, so interesting.
Unless maybe with TradeStation you could, or Thinkorswim or something, you could write code that would change your stop every day for you.
Mm-hmm. Yeah, the target. Yeah. Yeah. So.
Or yeah, the target too, because these are dynamic targets and stops. Very dynamic, very you'd need to code the trading platform to even trade this.
Yeah, this is
But that one you wouldn't. That one you could just set it and forget it.
mm-hmm. Okay. Yeah, so having a target stop, I think, helped overall. In addition to the protective stop, to have a target stop.
Yeah.
Any additional questions here?
So you picked the channeling because it was the system with the most promising system.
No,
The most promising so
it was
far.
just the first. First one in line, I think.
I took notes from last week, and where you did them all, and it looked like channeling and OR long were the most promising
Yeah.
systems,
Yeah.
and with the SPY and channeling was the most promising. Channeling and triple screen were the most promising systems, with the CBOE and the Russell 3000.
Mhm.
So
Yeah.
so it's a good one to focus on.
Mhm. Okay. Okay. Let's see. Okay. One of the item was to go through Howard Bandy's book, and so this is the Cornell notes on the chapter 4,
Mhm.
and so for so I just these are the notes. One thing Howard Bandy says is to keep win rates above 65%.
Mm.
The reason is below that, the risk increases dramatically and profit potential drops. And then he also says we should use this, he calls it CAR 25, which is, so it's more of it's an objective function, but essentially it's just the compound annual growth rate that has a objective function at a confidence level of 25%. So this is using statistics. You have a distribution, and you come up with a distribution of like equity curves, and he says that we should have it. So we set up a target compound annual growth rate. So this is the CAR is essentially a compound annual growth rate formula. And then, so as you do the back testing, you come up with a distribution of equity curves, and you can come up with what is the 25% confidence level. And as long as that number is greater than your target, then you should be okay. At least that's how the way I understand it. It's in reading the book, it wasn't as clear, but that's my understanding of what this CAR 25 is. So we'll have to study that more. The one thing that's interesting, he's saying that the sweet spot for holding period is 1 to 2 days, and that longer the holding period, the lower the risk normalized profit. So it's lower profit as you go beyond 1 or 2 days. Yeah, in terms of risk tolerance, you wanted to get drawdown to have less than 5% chance of having a 20% drawdown. Is to look at drawdown as an early warning to reduce position size. Monitor trade by trade, adjust position size as performance changes. Yeah, so this is that dynamic position sizing, Dan, that you're talking adjust position size as performance changes.
Yeah, and I've read the chapter 4, and I went into the index, and I found where, I think it was like on page 40, the pages 40 through 45 or so, he talked about the safe F, and about the dynamic position sizing and the CAR 25.
Mm-hmm.
But the bottom line is, these are fairly complex formulas, some of them which require using and he developed them, so it requires using his Python code. I think he mentioned with Ami Broker.
Mm-hmm.
So there's some dependencies there in fully implementing his ideas, but his general ideas, I found them helpful.
Mm-hmm.
Although somewhat discouraging, saying things that you're competing against Goldman Sachs. Well, we are, but not just against Goldman Sachs. I do believe I am competing with some people that aren't as good as me, as well as many people that are better.
Yeah. Yeah, I think he's also somewhere he's saying to create just focus on one symbol.
Yeah, for back testing. He's trying to get the most possible confidence.
Mhm.
Well, we can kind of do that, right? With the multi-factor testing, it'll allow you to rank which symbols do well with
Mhm.
a system and which don't.
Mhm.
And so we can kind of have our cake and do it too with EdgeRater on that point.
Yep. Okay, so then he had a checklist of things. I just copy and pasted his checklist and said to read Daniel Kahneman's book. Let's go, and then to define your personal risk tolerance. Include all trading rules as formulas in your models. Use CAR 25. Trade a single issue, long or flat. So you're either long or you're out of the position.
Yeah.
Pick an issue that passes the data prospectors to filter. Enough volatility, but not too much volatility.
Right.
And then use state signals. I remember we talked about this before. Remember there was the crossover where we generate a pulse versus like a more of a state signal. That's just, so he says use state signals. Mark to market daily. Just use a small number of indicators. So the sweet spot is a 65% win rate and holding for 1 or 2 days. Positive expectancies. Okay, so then I have something on the walk forward testing. Just to seed the thought, and then we can discuss it and do more of this type of back testing. Walk forward, and then use safe F for position sizing. So safe F is position sizing so that the risk is of a 20% drawdown is less than 5%. So you want to have a low probability of having a 20% drawdown. So then using that position sizing to compute the CAR 25. And so using safe F for position sizing and then doing the equity curve analysis and then decide whether the return is worth trading. And then to apply dynamic position sizing. Yeah, so I just want to touch on this back testing, the walk forward that he mentioned, that Howard Bandy suggests we use to use walk forward testing. So actually, a number of people do use that. They prefer walk forward back testing. So what we've been doing is more of the traditional back testing. So we have a long in sample period and then a shorter out of sample. So here it's like a 17-year back test for in sample to come up with the parameters, and then using that as the parameters to use on this out of sample. So out of sample is to mimic future unseen data. So walk forward is similar, but what it does is it breaks it down into chunks. So you have in sample period, and then for this shorter in sample period, you come up with the parameter optimization for this out of sample period 1. Then you step down and do another in-sample period and do the parameter optimization for this out of sample period 2. And then here you do another in-sample, you do parameter optimization for this out of sample period 3. So it's basically doing these in smaller chunks, offset by the period of out of sample testing. And then some people have as many as 10 of these, so that you're doing multiple out of sample. So the concept is you develop the parameters for out of sample 1, the parameters for out of sample 2, the parameters for out of sample 3, and then run out of sample 1, 2, and 3 as one run. So the orange are all unseen data that you're optimizing the parameters based on the history. So it's trying to mimic what we would do, because for example, let's say we come up with a system and with a set of parameters, but every so often, let's say 6 months or so, or up to a year, we would want to rerun parameter optimization just to make sure that we're in sync to the market. So this is a similar concept here. It's trying to mimic what we would normally do. Yeah, this way here, it's the traditional way. Yeah, it's not adjusting to the market, adapting to the market as much as here. Here it's adapting much more frequently.
I could imagine that if you ended up with 3 parameter sets, kind of the 2017 one, the 2018 one, and the 2019 one, that you would actually want to be running tests with every one of them, because when you finish the 20, once you've got 2 parameter sets, you don't know whether your new parameter set is going to be better than your old parameter set in the future. So if you kind of kept the old parameter set around until it was disproven by, failing a couple retries, I don't know. I'd hate to get in a situation where I guess it's okay to just be changing the parameters back and forth, because presumably whatever your parameters were would be the best ones for the present time with this approach.
Yeah. So this is the walk forward, and then people have varied the length. Like here it shows conceptually 4 years.
Yeah.
Others can vary it. They actually recommend varying the length of these backtest periods, so that you have so the main point is to come up with a mixture, a variety of different periods, so that you're not it's trying to get variation or adapting to the market condition. And so if it passes, so if when we run the back testing of out of sample 1, if it looks good, and then out of sample 2 looks good, and out of sample 3 looks good, then that means this is a pretty robust system, because it's yeah. So it's that's the general concept of walk forward. And then this next slide just gives more details of how to run it. So I think what over the next 2 or 3 weeks, using the batch testing that EdgeRater has, we can do some manual walk forward back testing to see how it looks. So that's yeah. So that's good that we looked at Howard Bandy's book, is to introduce walk forward into our process.
Yeah.